Good afternoon, everybody. You're very welcome to this, which is actually the last Geary seminar, Tuesday seminar for this academic year. Today, I'm delighted to welcome Tara McIndoe-Calder, Senior Economist with the Central Bank. Today, Tara is going to talk to us about household wealth inequality and resilience. As per the standard format for the Geary seminar, we will take questions through the Q&A format and get to them at the end of Tara's presentation. So Tara, without further ado, over to you.
Thanks very much, Doran. So good afternoon, everybody. Thank you to the Geary Institute and Doran for having me today. I'm delighted to share this, this policy paper with you. So the work is co-authored, as you see there, with Ray Lydon and David Horan, neither of whom are here today to take the hard questions, so I will battle on valiantly in their absence. This work is joint. It's just recently out as an ESR policy piece, and some of it actually comes from a bank sort of technical paper that we released in the autumn. So I can share the details of those with you if that's of interest. So household wealth inequality and resilience. So by way of roadmap, and let me just minimize the videos here so I can see my whole slide. Okay, so by way of roadmap, we use survey data from 1987, 2013 and 2018 to identify factors driving wealth dynamics in Ireland. And we do a little bit of comparison with the Euro area, but primarily a focus on Ireland here. And we find that ownership of housing is crucial, something which we kind of had an idea of from both the 1987 and 2013 surveys. And then also that changes in asset prices and leverage are really important. And that's the nice thing from having two rounds of the recent survey to look at. So when we compare across the three surveys, across the sort of 31 years, we find that inequality rose between 1987 and 2018, with high leverage in the middle contributing to this, as well as falling home ownership. Between 2013 and 2018, however, the fall in negative equity changes the story a bit, which I'll go into in a bit more detail. And then lastly, just a little bit on financial resilience. So on the eve of COVID-19, households were more financially resilient than at the onset of the financial crisis. So we use some admin data and sort of granular simulation to take the 2013 data back to 2008 in order to make this comparison. So some motivation and background, understanding the reasons for wealth disparities and developing policies to address them are arguably some of the biggest challenges we face as a society, and increasingly central banks are interested in this also. There is fairly limited information for Ireland compared to other developed countries until that is the Household Finance and Consumption Survey, of which we now have two waves. The third wave is forthcoming. It was actually in the field in 2020, which is very interesting. It will be very interesting when the results come out to look at the sort of pandemic effects on household finances. So the HFCS, as we refer to it, is a joint project of the Euro area, excuse me, central banks, 3 EU countries and various national statistics institutes. In Ireland, approximately 5,000 households have participated in the survey waves to date. For 2013 and 2018, it was a repeated cross-section, but the survey that was in the field last year includes a substantial panel element, which is very exciting, especially for researchers. The CSO do a really great job in collecting this data. They have lots of practice of collecting household data now, and they use very high quality admin data for very large portions of the survey households and covering important components of household finances. So specifically income, some assets, including large assets like houses, and also some expenses or incomes, depending on where you sit in the rental market. So the consumption data is a fairly small component and is probably not as good as the HBS data. However, the trend is okay, and the sort of individual items that are gathered, for example, food expenditure, that's okay. So it gives us a kind of a steer on what's going on in consumption. And then there are some important components of financial assets which appear to be underreported when we check with the aggregate statistics, of which the central bank has lots. So it looks as though the HFCS only captures about 30% of deposits, which are a really important financial asset for Irish households. So deposits are underreported across the euro area, but in particular in Ireland. It does look, however, as though the trend is probably okay. And also across the distribution, the underreporting is kind of fairly similar. So comparisons across time and across the distribution, at least as sort of giving an indication, are fine. So those are kind of the main caveats. Okay, this audience probably doesn't need to be reminded, but when thinking about household finances in Ireland, the context is really important. So what we have here are house prices, employment and income indexed to 2007, which was kind of the peak before the financial crisis. The black lines there indicate the HFCS surveys, so in 2013 and 2018, and you can see that the 2013 survey kind of was collected close to the low point after the previous crisis, and then the 2018 survey was collected arguably very close to the next high point. And in particular, incomes and employment had sort of surpassed their 2007 peaks by the time the 2018 data was collected. And house prices had recovered huge amount of the over 50% falls that they saw since the previous crisis, but still had a little way to go, 15%, to get back to the 2007 peaks. So that's just to bear in mind when I'm presenting the 2013 compared to 2018 statistics, I guess. So the main findings when we sort of descriptively look at the 2013-2018 comparison, and I'll go into this in a little more detail in the slides to come. So Irish households saw the largest net wealth increases across the euro area countries. This was predominantly due to house price growth, and that's in part to do with the very high relative volatility of house prices in Ireland and the points in the economic cycle at which the survey was carried out. It was really accentuated for Ireland, I guess. So financial asset participation is also a factor in the net wealth increases seen in Ireland, and financial asset price growth, which I guess was seen much more widely. So wealth inequality actually fell in Ireland, and this was predominantly due to rising net wealth at the bottom, due to the sort of disproportionate effect that negative equity had on the inequality statistics in the 2013 survey. So housing ownership is crucial for understanding wealth patterns, both within waves and across time in Ireland. So by 2018, we had returned to a situation where home ownership in the bottom quintile, was very rare. So 1 in 1,000 households own their own home in the bottom quintile. Whereas in the top quintile, they have sort of less debt than the average household and much more diversified asset portfolios, including diversified financial asset portfolios, including pensions and business wealth disproportionately to other parts of the distribution. Leverage is also important, and in particular for household financial resilience, as we go into a little more detail towards the end of this presentation. So between 2013 and 2018, rising wealth was actually accompanied by improvements in financial resilience, which is in contrast to the situation sort of prior to 2008. And then wealth and income remain fairly highly correlated in Ireland, sort of in the middle of the pack compared to other euro area countries, and that sort of gives some indication of where policy may be able to affect both wealth and income inequality potentially going forward. So just picking up on the point there about the large net wealth increase in Ireland compared to the euro area. So this chart gives the median net wealth by country for euro area countries, and we can see here Ireland is sort of, in the top part of household net wealth for the euro area, but saw this huge proportionate gain between the two survey waves. So in fact, the median net wealth in the euro area fell by 0.5% for households between 2014 and 2017, which is when most of the other countries gathered their data. But in Ireland, we have this very big increase. If we look at the components of net wealth, just sort of stacking them all up, we can see that the headline takeaway here is that between 2013 and 2018, there was an increase in 2.9 billion euro of net wealth in Ireland, which translates to 82,000 euro for the median household. So the chart on the left aggregates the components of net wealth, and we can see that all the work really is done on the asset side, and in particular by real assets, of which the vast majority by value is housing assets. There is a fairly large increase in financial assets, which I'll talk about in a minute. And there is a small decline, sort of relatively, in debt. So to do with households paying down debt and not taking out additional debt, rather than anything going on with term or interest rate, for example. And then on the right-hand side here, we can see that although they were very large, this plots net wealth by net wealth quintile. So we can see that although in the top tail there were large level increases, the proportionate increases were very big for the second and third quintiles. And this again is this negative equity effect. So loads of houses who had HMR mortgages, household main residence mortgages in 2013 and were in negative equity, they were then in the bottom quintile of the net wealth distribution. And having seen large house price appreciation in the intervening years, they've now moved up to the second and third quintiles, which is, probably more realistically where, they would expect to be in the overall distribution. Okay, so if we just have a quick look then at the components, various components of net wealth, we look at real and financial assets, and then secured and unsecured debt, which together constitute net wealth. So gross real assets account for 82% of aggregate gross household wealth, and here we plot gross wealth by quantile of the gross wealth distribution. So we can see that these bottom two shaded areas are the real assets. So HMR property assets are really the dominant asset in Ireland, followed by non-HMR property, and this includes farms and investment properties. And then other real assets make up the majority of the assets for over 2/3 of the assets for the bottom quarter of the distribution, although much smaller proportion higher up. And then financial assets make up a large share for the bottom quarter, but up here they're very diversified. So down here it's mostly deposits, and up here there's a much more equal split between deposits, pensions, and other financial assets. Okay. So participation remains broadly unchanged. The median value of property is up substantially, so by 100,000 here. I'm just keeping an eye on the time. So in 2000, and the top two rows here show participation. So we can see that participation remains broadly unchanged, although HMR or household main residence, owner-occupied housing fell slightly, as well as other property participation, sort of representing the fallout from the financial crisis. And there have been increases in some real assets, but it's the value increases here which are the main thing. So up substantially for property in particular, but also for things like self-employment, business wealth, which makes up a sort of a smaller share overall. Okay, so financial assets then, I've hinted already that diversification at the top is much more substantial than at the bottom, and here we see that really starkly. So in the bottom quintile of gross wealth, deposits make up fully 94% of all financial assets, whereas in the top quintile, it's much more equally split between deposits, pensions, and other types of financial wealth. Okay, so voluntary pension participation is up, especially at the higher end of the income distribution. So this shows the participation in voluntary pensions by gross household income distribution rather than wealth distribution. So we see here these very large participation gains in the top part of the distribution. There may be a slight comparability issue here. So in 2018, the CSO did a really good job at surveying, oversampling the wealthy, and there is a high correlation between wealth and income. So it may be that we are sort of capturing this better this time. But regardless, you know, sort of very stark differences across the distribution here. Okay, so debt then, having looked at real and financial assets, we can see here that debt is also down. So from in aggregate from 120 billion down to just over 100 billion. And on the left-hand side, we can see the makeup of this aggregate debt profile. So HMR mortgage and other mortgages make up the vast majority of debt, so collateralized debt, which is not surprising. There has been a bit of an increase in other non-mortgage debt, which is not actually PCP finance. It's more like loans to other households, we think, according to the CSO. And then there has also been, so the chart on the right shows, and this hints to some of the work that we show towards the end of the paper, sort of the nice improvement across the age distribution this time on debt to income ratios. So the green lines are for Ireland, the dashed line for 2018 and the solid line for 2013, and the blue lines are for the euro area, for the second and third waves of the euro area survey. And we can see that in 2013, debt to income for households in the sort of 30 to 50 age cohorts were really substantially different and much higher than euro area peers, whereas now we look much more in line with the euro area, and there's been this really substantial improvement in debt to income ratios for households, of which I guess the macroprudential or mortgage rules play some part. Okay, so again, just to give an indication of participation and median value for households of these various components of debt. And again, we see here the fall in participation in mortgages or in property. And so we saw before at on the asset side and here on the debt side, a sort of fall off in participation in mortgages and also a fall in value in part because households have been paying this down and not taking on additional debt, which was really a huge feature of the build up to the last recession. Okay, so combining all of these different components of wealth, we can look at the dynamics over time in Ireland of wealth inequality metrics, and we also do a comparison within the euro area. We will also have a look at the role that income plays, and also the role that intergenerational transfers play in accessing some of these key asset classes in Ireland. So over 3 decades for Ireland, and since 2010 for the euro area, we have a variety of wealth inequality metrics shown here. And if we have a look first at the euro area, we can see that inequality has been increasing over time. So the Gini coefficient has, increased marginally from 0.68 in 2010 to 0.7 in 2017. And that's reflected in the ratio of the 80th centile to the 20th centile is higher, and also the 90th to the 50th. So wealth is becoming more concentrated at the top, is what these metrics are showing. So for Ireland, then, we have a longer time series back to 1987, where some of these wealth inequality metrics are comparable, and we can see that there really has been a big increase in inequality from 0.52 in the 1987 survey to 0.67 in 2018. But then this negative equity effect and leverage effect sort of really substantially raised inequality metrics in 2013, because a lot of those negative equity houses had almost no net wealth when measured in 2013, but have now moved into the middle part of the net wealth distribution, as I showed earlier. So over the sort of longer time horizon, inequality is rising and maybe converging on what it looks like in the euro area, although there was this improvement in between 2013 and 2018, which we think we understand fairly well. So we can see that some of these ratios look very volatile for Ireland, and again, it's to do with the very low amount of of net wealth in the sort of very low parts of the wealth distribution in 2013, and it sort of has normalized a bit now. And we can see then for Ireland, wealth becoming more concentrated, say if we look at the top 1 percentile, so increasing 50% almost from 1987, although some of these other ones don't look quite as stark as that, which is interesting. Okay. So this chart on the left, which Ray put together, is really cool. I think it really makes the point so starkly about the house price growth in Ireland compared to the euro area. So this chart plots the average annual growth in net wealth between the two surveys of the HFCS as a percentage of income by quantile of the net wealth distribution. So to try and net out differential income across the euro area and try and just get a handle on exactly what role house prices are playing. So the solid line is the actual data for Ireland, and a solid blue line and the solid orange line is the rest of the euro area for the distribution of net wealth. And then the dashed line is Ireland, where we have applied the average euro area house price growth over the 2013-2018 period. So it really is astounding how much of a difference it makes giving Ireland the house price growth that the euro area had. The gap then in the middle part of the distribution in particular here is debt differentials. So euro area countries on average took on debt by about 10 percentage points, and Ireland paid down debt. And then on the right here, we see how important housing tenure status is for net wealth accumulation, both in the euro area and in Ireland. So in Ireland, being a homeowner is really important for large amounts of wealth accumulation, and leverage assists in this substantially. So we can see here 135,000 is the median change in net wealth between the two surveys, which it's also substantial for euro area countries. But interestingly, in Ireland, there's also been a fairly large increase in median wealth for non-owners, so renters, and it sort of remains to be seen whether, you know, this is reflecting homeowners, potential or future homeowners needing to accumulate larger deposits in order to access housing in Ireland with the introduction of the macroprudential rules, or whether non-homeowners are, you know, diversifying and acquiring other assets. Okay, so is the increase in inequality between 1987 and 2018 driven by financial asset diversification at the top? We saw previously that the diversification in financial assets at the top compared to the bottom is really very substantial. So these bars look at the income distribution to the bottom 70%, the next 20%, the top 10%, and of that, the top 1%, and compare 1987 to 2018 for each of these parts of the distribution. And we can indeed see that there is increased financial asset holdings between 1987 and 2018 all the way across the distribution, but that in the very top parts, financial assets make up you know, up to a third of all assets in 2018, so triple the share from 1987. In fact, however, this is not clear that it is financial asset diversification. There is a large role for property ownership in income inequality metrics. And we can see this if we look at the distribution across the net wealth for financial assets and HMR property. So the comparison between 1987 and 2018, if we focus initially on financial assets, we can see that although there is increased financial asset holdings in the top 1%, there's actually substantial increase in the bottom 70% as well. And it's the sort of next 20 who've lost out a bit. And similarly, and maybe even more starkly for the change in the distribution when we look at HMR property. So the bottom 70% have a little more, driven by leverage in the sort of second and third quintiles. And the next 20%, the concentration is becoming substantially less, although it is increasing again in the top 10% and in the top 1%. So there does seem to be a further channel here for housing wealth in driving wealth inequality, so driven by two channels. So falling owner-occupier rates, so the owner-occupier participation was 79% in 1987 and only 69% in 2018, and increased leverage. So the average LTV in 1987 was 29% loan-to-value ratio, whereas in 2018, even despite 5 years of balance sheet repair, was 41% on average. And this sort of assumes differential house price gains across the distribution, which arguably it would be difficult to believe, I think, in Ireland. Okay, so having looked at wealth and some of the channels through which wealth inequality has increased over a relatively long time period in Ireland, we can also see in this survey, which jointly collects income and wealth data, that wealth and income are indeed fairly highly correlated. So income and wealth clearly have the potential to be closely linked. Higher income households may be able to save more and accumulate wealth more, in part due to facing lower credit constraints. And UNESI in 2013 for the euro area find a positive, although less than 1 correlation coefficient for income and wealth. So in Ireland, the correlation is 0.14, which is higher than in 2013, again, due to the reduction in negative equity, which sort of restored those households to the middle of the wealth distribution from the very bottom. And then the correlation is also increasing up the wealth distribution. So we can see here in these three columns that the share of wealth, in the top, for the top households, there's a very high correlation here. So more than half of the wealthiest 9th and 10th decile households are also in the 9th and 10th income deciles. And similarly in the top 1%. So 50% of the top 1% of households by net wealth are also in the top decile of income. So there are policy implications there. So policies to address income inequality may have knock-on effects to wealth inequality and vice versa. So now we can use some of the HFCS data is very wide and includes in 2018 several questions on intergenerational transfers or inheritances and gifts. So inheritances may affect inequality in the long run. So of course the work by Piketty and co-authors, including via intergenerational wealth persistence. And there's a big literature here, but not universally. Okay, so Nikoy and Seam in 2018 show that in Northern Europe that inheritances can actually reduce savings and lifetime labor supply, reducing lifetime wealth. So it's important for policymakers with regards promoting equality of opportunity and taxation of inheritances to think about how intergenerational transfers may affect wealth inequality and participation in sort of key assets which contribute to wealth accumulation, lifetime wealth accumulation. So as I said, in the HFCS data, we have a few questions on inheritances and intergenerational transfers. So we see in 2018 that 25% of households received a substantial inheritance in the 3 years prior to the survey. So a fairly large proportion of households. So on the right here, I plot the share of households receiving a substantial inheritance and the inheritance type across the wealth distribution. So the most important inheritance type is money, which is not surprising, although at the top end of the distribution, property and land also have large shares and also businesses with financial assets and other real assets having a much smaller role. And then the receipt of an inheritance increases, so the likelihood of receipt of inheritance increases substantially across the net wealth distribution, up to 70% in the top tail. So although causal identification is not possible with the questions in the 2018 survey, we can see that there is a high correlation between inheritances and home purchase. And we think that this channel is important and may become increasingly important. So the probability of purchasing your home between 2013 and 2018 was 23% for all under 40-year-old non-homeowners in 2013. And 33% for those who received an inheritance within 5 years of purchase. So this difference remains after controlling for income, age, gender, and marital status. And we can see here in the sort of third and fifth columns that the inheritance value is also positively correlated with purchase and with the size of the deposit. So this looks like a sort of interesting channel for property acquisition here, and a channel which has been identified elsewhere. Okay, I see that there's a question here, but I might just leave that to the end now because I'm not sure how long it's been there. Apologies if it was a clarification question. Okay, so resilience then and balance sheet repair. So rebuilding and safeguarding household financial resilience was a really big lesson from the financial crisis, and in particular, I guess, for the central bank and also for researchers at the central bank. So macroprudential policy, which has been in place since 2015, seeks in part to do this. So, for example, by implementing loan to value or debt to asset and loan to income, or debt to income rules, depending on what lexicon you use. The macroprudential tools aim to prevent excess credit growth and leverage. And then arguably COVID-19 represents the first serious test of household financial resilience since the financial crisis. So 2013 to 2018 sort of are characterized by substantial balance sheet repair, and we saw that when examining where the sort of large net wealth increases came from between 2013 and 2018. So aside from house price increases, there was also this debt reduction and debt service improvement. So we list here for age of household head, debt to asset or LTV, median LTV in these age cohorts in 2013 compared to 2018, as well as LTI, debt to income, the median for these age cohorts, and then also to get a sense of the debt service burden on which there's not an explicit macroprudential rule. And we also look at the top tail, so the percentage of households in each of these age cohorts where debt service is more than 40% of income, current income. And the nice thing about the HFCS is that we have sort of current income, not income only at loan origination. So LTV, LTI, and debt service metrics have all improved. Growing incomes, so there was income recovery of nearly 20% between 2013 and 2018, were substantial drivers in these sort of middle columns. Rising house prices were, really important, as we've seen before, and also falling debt levels. So at the median, the biggest falls were for the 30 to 49 cohorts, which were really very highly indebted going into the last crisis. But in the tails, it's actually the 40 plus cohorts which have seen the largest fall off. So for example, in these very high debt service categories, it's the gains have disproportionately been in the older cohorts. Okay, so if we compare household resilience at the onset of two shocks, 2008 versus 2018. So we use work that we developed after the 2013 round of the survey, where we simulate using a mix of administrative data on incomes and granular imputation of debt, because it's very rich, the HFCS data. You can work out what was going on with debt, especially over a time period when few households were taking on large secured debt, for example. So we roll all the different aspects of debts and incomes back to 2008 from 2013 and have a look to see what the debt metrics are, so the LTVs, LTIs, and debt service metrics. And here I just focus on HMR debt. So we can see HMR debt to income across the LTV distribution. So we can have a look at the tails as well as the median. So we can see here that in 2018, which is a solid line, the median LTI was around 1.5 compared to the median in 2008, which was much higher, 2.5 in the middle of the distribution. And this gap widens considerably in the top part of the distribution. So you can see that the sort of median LTV for the 90th centile of the LTI distribution is, this is debt income, was much higher, nearly 700. Sorry, it's this next one, which is debt service. So an idea of monthly or annual income used to service HMR debt. which shows a similar pattern, unsurprisingly. So households are diverting far less of their income to HMR debt service in 2018, which is a solid line compared to 2008. So at the median and conditional on having HMR debt, this was 12% in 2018 compared to 17% before the financial crisis in 2008. And if the tails are of interest, the gap widens substantially on the right-hand side. So in the 90th centile, the median debt service was, 47% in 2018 compared to, less than 30% even in the top tail in 2018. So there is, of course, it still remains very uncertain exactly what the COVID shock will look like for household incomes going forward. However, using the HFCS data, we can see that going into the pandemic, households appear to have been more financially resilient than they were going into the last crisis. So some conclusions then, there has been a large improvement in the wealth position of Irish households between 2013 and 2018. Housing plays a large role in understanding wealth dynamics in Ireland over a longer time period from 1987. Between the waves of the HFCS data, most leveraged households saw the largest wealth gains, for example, moving up from the very bottom to the middle of the, to upper parts of the wealth distribution. And by 2018, there was a reversion to the sort of long run pattern of very low home ownership, for example, in the very bottom of the wealth distribution. Leverage also plays a role in the longer run. So property leverage contributes to concentration of wealth between 1987 and 2018, which I hope I've convinced you of, as well as a role for falling home ownership. Financial asset holdings have increased across the distribution, although wealthier households are more diversified. Policies to address wealth inequality perhaps should not focus solely on property, for example, would be one of the policy insights we think here. Income and wealth remain correlated in the cross-section. So as I mentioned before, policies to address income inequality may have positive externalities for wealth inequality and vice versa. I've shown some novel stylized facts on intergenerational wealth transfer, which looks to be a key channel for acquiring owner-occupied housing in Ireland and may also affect the leverage, for example, on mortgage down payments. So resilience metrics have improved, positioning households, far more financially resilient on the eve of the COVID pandemic than they were in 2008. Okay, that's all for me. Thank you very much for your attention, and I can see that there are some questions there.